If I were forced to summarize what I believe this moment represents, I would put it very plainly. I do not think the world is ending. I do not think markets are about to stop working. I do not think wealth creation is going away. But I do think windows exist, and I think most people only recognize them after they have already narrowed. That is the pattern I have seen over and over again. The crowd calls something obvious only after the largest rewards have already been collected. The crowd wants clarity before it commits capital. The trouble is that clarity is expensive. By the time the story feels safe enough for the average person to believe it confidently, prices have usually moved, leadership has usually formed, and a large portion of the asymmetric upside has already been consumed by those who acted earlier with a calmer mind. That is why I have always preferred to think in terms of conditions rather than headlines. Headlines tell you what happened today. Conditions tell you what kind of decade may be quietly forming underneath the noise. And when I look at the current landscape, I see something that appears only rarely. I see several major curves beginning to rise at the same time. I see a market where most of the future gains may belong to a smaller set of leaders than people realize. I see demographic changes that may make broad, easy growth harder in later years than it has been in the past. I see the easy money regime behind us, which means the market will likely reward real productivity, real dominance, and real cash generation more harshly and more selectively than it did when liquidity was carrying almost everything. And perhaps most importantly, I still see disbelief. That is the part people underestimate. Disbelief is one of the greatest gifts the patient investor ever receives. Because while the crowd remains uncertain, while the public is still waiting for proof, while commentators are still debating whether the move is real or temporary, prices are often still being set in a zone where future returns can be unusually attractive. Once belief becomes universal, the bargain usually vanishes. I have lived through enough cycles to know that great wealth is not usually built by buying after the whole world agrees with you. It is built by understanding which conditions can create extraordinary returns, then placing capital with discipline before consensus becomes comfortable. That does not mean gambling. It does not mean theatrics. It does not mean selling the house to buy the newest trend. It means recognizing that every decade is not created equal. Some stretches are generous, some are mediocre, some are narrow, some belong to owners of broad enterprise, some belong to owners of very specific dominance, and every so often there is a stretch where a handful of changes in technology, infrastructure, policy, capital flows, and behavior begin clustering together in a way that can create unusually lopsided outcomes for those positioned correctly. That is what I believe we may be looking at now. Not certainty, but a rare setup. I remember many periods in my life when the public asked the wrong question. They asked whether prices were already too high. That is not always the right first question. The better first question is often, are we still in the early phase of something that will end up much larger than the present market imagination? If the answer is yes, then a stock or a fund can look expensive by old static measures and still turn out to have been a very good purchase. I saw that in consumer brands, I saw it in insurance, I saw it in network effects, I saw it in software, and we are seeing versions of it again in artificial intelligence, automation, infrastructure, semiconductor supply chains, defense technologies, grid expansion, cybersecurity, and the capital equipment that supports this whole transition. The public has a bad habit of assuming that because a trend is visible, the money has already been made. That is not how exponential adoption works. The beginning is often obvious only in hindsight. While it is happening, it feels partial, overhyped, controversial, uneven, and concentrated. That is exactly what makes it investable. If every person on the planet agreed that the future belonged to a given set of technologies and that the profits were guaranteed, the prices would already reflect a great deal more than they do now. But they do not fully. And that is why I think it is possible that the next 5 to 10 years may offer a window that later periods will not. Not because growth disappears forever after that, because the biggest percentage gains usually occur before certainty matures, before the infrastructure is fully built, before the market leadership is completely settled, and before every institution has allocated to the obvious winners with total conviction. This is one reason I say the best gains often happen before the story sounds safe. People think the safest point must also be the smartest point. Sometimes it is simply the most crowded point. Every era has its own disbelief phase. There was a time when the public thought the internet was an interesting toy rather than the architecture of a new commercial order. There was a time when people treated mobile computing as an extension of personal convenience, rather than a reshaping of entire industries. There was a time when cloud infrastructure, platform businesses, and digital advertising looked like category-specific stories rather than new economic layers. By the time those things were fully accepted, the easiest money had been made. The lesson is not that every exciting new theme is real. The lesson is that when several real themes begin reinforcing one another before the public has fully priced the scale, the resulting period can create fortunes for disciplined owners. That is what I mean when I say this may be a major wealth window, not a lottery. A wealth window, there is a difference. A lottery asks you to predict some sudden break. A wealth window asks you to understand long-duration forces before they become obvious enough to flatten returns. Let me tell you the first force I see. We are standing near the front edge of several exponential curves at once. That matters more than people think. One exponential curve by itself can create good returns. Several overlapping curves can create an entirely different economic environment. Artificial intelligence is no longer an experiment in the abstract sense. It is already moving through businesses, raising margins, automating tasks, changing labor economics, and forcing capital spending on infrastructure that did not exist at this scale a few years ago. Data centers are not being built for amusement. Grid upgrades are not being discussed because the world got bored. Semiconductor demand is not expanding because a handful of analysts wanted a new narrative. These are capital intensive changes connected to real economic reallocation. When that kind of reallocation begins early, the companies supplying the picks, shovels, platforms, compute, memory, interconnection, power management, and software orchestration can become astonishingly profitable before the broader public fully understands how deep the demand stack really is. I do not use the word astonishing lightly. The largest fortunes in markets are often built where capital spending precedes universal recognition. Once the whole world understands exactly who will benefit and by how much, the market is already charging you heavily for the privilege of owning it. Now, we are also seeing energy and grid transition needs interacting with this same technological wave that is very important. A lot of people talk about digital growth as though it happens in a vacuum. It does not. Every major computational leap requires physical support, power, cooling, transmission, fabrication equipment, networking hardware, industrial build-out. A great many investors still think in old categories as if technology were somehow weightless and separate from infrastructure. That is a profound mistake. The next decade may belong not only to the visible software winners, but to the less glamorous industrial and hardware backbone that makes the digital layer possible. This is one reason I think the opportunity is still younger than it looks. The visible applications of AI get the public's attention. The invisible physical system underneath it is where a great deal of capital is still being deployed and where a great deal of future profit may still emerge. Then you add biotechnology, longevity, research, automation, cyber defense, modern defense systems, and space-related infrastructure on top of that. I am not saying every one of these areas becomes a clean investing victory. They will not. Many companies will fail. Many will be overpriced. Many will never convert promise into durable owner economics, but that is not the point. The point is that the number of large, meaningful, real world transformation curves now arriving together is unusually high. That does not happen every year. When it does happen, the market tends to reward those who can distinguish between durable enablers and passing theater. This is where concentration enters the picture. Most people still think in very broad market language. They assume that if the economy grows, the market grows, and that growth will be distributed in a fairly healthy way across the major averages. That has often been true enough to be useful. But there are periods when returns become very concentrated in a narrow set of leaders. We are living in one of those periods, and I do not think people fully appreciate what that means. A concentrated market is not automatically dangerous. It is informational. It tells you where profit power, attention, and capital intensity are clustering. When the top names in the market account for a very large share of total market value, that is not a random curiosity. It means leadership is narrow. It means broad participation is weaker than the headline indices may suggest. It means many stocks can lag while a smaller group does the heavy lifting. Now, that can worry people, and sometimes it should, but it can also signal where the real engine is. The public has a strange instinct in these moments. It sees concentration and says the move must be over because too much has already been captured by the leaders. Sometimes that is true. Sometimes concentration is a warning. But sometimes concentration simply means that a small group of businesses are benefiting from forces that are much larger, more durable, and more economically important than the rest of the market has yet absorbed. That is a very different situation. If the leading companies are not just fashionable but are positioned at the center of the new capital cycle, then concentration may be describing an early truth rather than a late excess. I think that is one of the core questions of this period. Are these leading businesses merely expensive symbols of enthusiasm, or are they the first major beneficiaries of structural changes that will continue producing cash, scale, and dominant economics for years? I lean toward the second interpretation far more than many cautious observers do. Not in every case, not at every price. But broadly, yes. The reason I say that is simple. Most long-term market returns do not come evenly from every stock. That has never been true. The broad average is often carried by a relatively small set of exceptional businesses that keep compounding while the median company disappoints, stagnates, or disappears into mediocrity. The public is usually shocked by this because it wants fairness in the return distribution. The market has no interest in fairness. It has interest in consequences. If a small number of companies capture the infrastructure layer of a technological transition, enjoy rising margins, reinvest at high rates of return, and remain capital magnets, then those businesses can dominate the outcome of broad indices for years. And if that is what is happening now, then the great mistake is not merely failing to pick every winner. The great mistake is underestimating how narrow the winning cohort may remain. That is what makes this period potentially so lopsided. You may not need to own everything. You may need to own the right engines. That does not mean concentration in a personal portfolio without thought. It means understanding that broad market returns themselves may depend on fewer businesses than in more generous decades. There is another reason I believe this window may be unusual. Demographics. This is not an exciting topic, which is precisely why it matters. The market loves what sounds futuristic and dislikes what sounds actuarial. Too bad actuarial reality wins in the end. For a long time, markets enjoyed powerful demographic tailwinds, growing workforces, expanding globalization, rising consumption, more favorable dependency ratios. A younger economic structure can produce extraordinary support for long-run growth because labor expands, households form, spending grows, and capital formation benefits from a large base of economically active participants. That tailwind is not disappearing overnight, but it is changing aging populations, slower labor force growth, and higher dependency ratios can alter the background rate of broad economic expansion for a very long time. That matters because many investors still carry assumptions from a period that may have been more demographically generous than the period ahead. When demographic support weakens, broad-based easy growth becomes harder. That does not mean no wealth will be created. It means wealth creation may become narrower, more selective, and more dependent on companies capable of outrunning the drag through productivity, technology, automation, pricing power, and unusual scale. Think carefully about what that implies. If the broad demographic tide is less helpful, then the companies that can break away from it become even more valuable. The public often hears demographic slowdown and thinks bearish. That is not the right reaction. The smarter reaction is this. If broad, easy growth becomes rarer, the businesses that can still generate extraordinary growth become scarcer and more valuable. Scarcity changes returns. That is one reason I believe the next several years may be unusually rich for owners of the right assets, because later, if demographics put a heavier weight on the broad economy, the whole market may become less generous, less explosive, and more compressed in its return structure. In that environment, the early phase of this technological build-out may end up looking like the last major easy to identify public market wealth window for quite some time. Not forever, but perhaps for a decade or longer. There is a fourth reason I take this seriously. The easy money era is behind us, that changes more than people realize for years. Zero rate policy and extremely abundant liquidity acted like a rising tide under many assets. Valuations expanded, speculative behavior thrived, mediocre businesses could finance themselves more cheaply than they deserved. Narratives mattered enormously because money itself was almost free. That is not the world we are in now. Even if rates move lower in phases, the broader lesson of the new era has already been taught. Capital has a cost again, and when capital has a cost, the market becomes more serious. It begins rewarding real earnings power, real balance sheet strength, real productivity, and real capital discipline much more severely. That is a healthier world for an owner. Even if it is less euphoric for a speculator, people hear higher rates and think negative for stocks. That is too shallow. Higher for longer or structurally higher real rates can absolutely compress broad market multiples over time. But they also force selection. They separate the businesses that truly deserve capital from the ones that merely enjoyed free money. And in a selective world, the companies at the center of major productivity shifts often become even more valuable. Why? Because they can still command capital, they can still produce margins, they can still justify investment. They do not need financial levitation to look alive. They are alive. That distinction is everything. I have no nostalgia for a market where nearly everything floats, simply because liquidity is abundant. That is entertaining. It is not as useful. A more selective era may produce fewer broad, easy winners and more enormous rewards for the genuine leaders. Again, that points toward lopsided outcomes. This matters for ordinary investors because they are still psychologically anchored to the last cycle. They keep waiting for a broad, comfortable, evenly distributed environment where it will feel obvious that investing now is safe. That may not come. What may come instead is a world where the right businesses keep doing very well. The wrong ones stagnate, and the average person remains underinvested because he never got the easy emotional backdrop he was waiting for. That is how fortunes are missed. Not by ignorance of the market, by emotional mismatch with the environment. And now I come to the fifth ingredient, which may be the most important of all. Sentiment still lags reality. The ingredient required for extreme wealth building is not certainty, it is disbelief. Disbelief is what creates the gap between what is happening and what has been fully priced. If every retail investor were euphoric, if every household were fully committed, if every media channel were treating this as an unquestionable golden age, I would be much less interested. That is not the tone I see. What I see is caution, fragile confidence, people waiting for proof, people worried about valuations, people nervous about geopolitics, people nervous about rates, people nervous about concentration, people nervous about AI being hype, people nervous about buying after strong moves. In other words, I see the exact emotional environment in which large opportunities can still exist. The market does not ring a bell and say now is the safe moment to buy the next decade. As winners, it usually does the opposite. It gives you partial evidence, mixed headlines, visible gains that still feel suspicious, and enough uncertainty that the timid keep hesitating. That is the setting in which the patient get paid. Clarity usually arrives after the re-rating. That sentence alone explains a great many fortunes. By the time it feels obvious that a major opportunity was real, the price of entry has gone up, the institutions are fully positioned, and the asymmetry is much smaller. That is why I do not want to wait for universal comfort. Universal comfort is expensive. Now, I want to be precise about something. I am not saying this is the last chance to build wealth forever. That would be foolish. There will always be opportunities. Markets will always create asymmetry somewhere. Human beings will always underprice something and overprice something else. What I am saying is narrower and more serious. This may be the last period for many years in which patient public market investors can still get exposure to several major structural changes before the return profile fully compresses, before institutional ownership becomes even more dominant, before the obvious leaders are priced with broader acceptance, and before slower demographic and capital conditions begin putting a ceiling on how easy the next phase of wealth creation feels. That is a very different claim, and it is one I take seriously. So what would I do if I wanted to express that view without becoming reckless? I would not abandon the base. Never the base matters too much. A broad market fund still belongs at the center of a sensible long-term plan because it gives you general ownership of productive enterprise, protects you from your own overconfidence, and keeps the whole system from depending on a few precise bets. I want that foundation. I want the part of the portfolio that says I do not need to be right about every detail in order to participate in progress. But I would not stop there if I believe this specific window may be unusually rewarding. I would layer it, first the base, a broad U.S. market or S&P 500 style exposure. That is the adult foundation. If you do not have that, I would begin there before becoming more imaginative. Second, I would add a broad innovation and growth backbone. A fund like QQ or QQM fits that role well, not because it is an AI fund in the narrow sense, but because it captures many of the largest and most economically dominant companies sitting at the heart of these overlapping transitions. It gives you exposure to software, platform economics, infrastructure beneficiaries, cloud leaders, and major adopters of AI and automation. It is not perfect, nothing is, but it is a rational expression of the idea that the largest productivity winners may continue capturing an outsized share of returns. Third, if I wanted a more focused layer tied specifically to AI infrastructure and semiconductor demand, I would add something more specialized. A fund like SMH or an AI and future technology basket such as RT can express that belief more directly. Now, I want to be careful here because specialization should not become intoxication. The public loves narrow thematic funds precisely when it should be most careful with them. I would not build a whole life around a narrow thematic sleeve, but I do think a controlled position in semiconductor and AI enablement infrastructure can make a great deal of sense if you believe, as I do, that hardware, compute, memory fabrication, and supporting architecture may remain among the most important economic bottlenecks and beneficiaries of this cycle. Why do I like semiconductors so much in this context? Because software narratives can become airy. Hardware demand is harder to fake when the world needs more compute, more memory, more advanced manufacturing, more data center build-out, more networking throughput, and more physical capacity. The companies upstream in that chain can enjoy remarkable economics. Not all of them. But the category itself becomes very important. This is one reason I think many investors are still too software-centric in how they imagine the next decade. The intelligence layer matters. So does the machinery that makes intelligence usable at scale. That is where some of the most durable profits may still sit. Now, if you force me to reduce the whole posture to a principle, I would say it this way. Own the base, own the leaders, own the bottlenecks, that is the framework. The base keeps you sane. The leaders capture the broad productivity winners. The bottlenecks capture the most economically powerful constrained parts of the build-out. That is not a promise. It is a rational structure for a specific kind of opportunity. I also want to say that patience matters more than precision here. People will hear a thesis like this and immediately ask when they should buy, whether the market will dip, whether rates will fall first, whether the geopolitical environment is too messy right now, whether the headlines make the moment bad timing. That is the wrong instinct. If the window is really measured in 5 to 10 years, then exact timing matters less than disciplined participation. The public keeps trying to use short-term discomfort to excuse long-term underexposure. A person says, I will buy after more clarity. Then clarity never comes in the way he wants. Or it comes after prices have gone materially higher. Or he says he will wait for a correction. Then the correction comes and he decides it may be the beginning of something worse. He waits again, then the market rebounds and suddenly it feels too late. Waiting often looks intelligent from the inside and expensive from the outside. That is why I prefer processes. Build the exposure in stages. Start with the broad base layer and the growth backbone. Add the specialized infrastructure sleeve in controlled size. Let time do the heaviest work. Do not try to turn a decade thesis into a weekly trading problem. That is how people destroy the advantage they were lucky enough to spot. A long opportunity deserves a long temperament. I have seen people take a fundamentally good idea and ruin it by demanding immediate validation from it. That is not ownership. That is insecurity wearing an investing costume. If this really is one of the rare windows where several technological, industrial, and capital forces are clustering together before broad acceptance, then the correct response is not emotional sprinting. It is calm positioning. Calm positioning is underrated. It does not flatter the ego because it lacks drama, but it is how serious fortunes are often built. You identify the conditions, you size your exposure rationally, you diversify intelligently, you let the machine run, you do not keep relitigating the thesis every time the market has a bad Tuesday. Now let me address the most obvious objection. What if it is already too late? That question is always asked when an opportunity has already shown enough strength to become emotionally uncomfortable. Nobody asks whether it is too late when prices are dead and no one cares. They ask when the thing has already moved enough that regret enters the room. Regret is a poor asset allocator. The better question is this: has the underlying economic shift largely matured, or are we still in the earlier part of a long adoption curve where the final scale of profits and infrastructure is not yet fully reflected? I believe we are still much earlier than the public mood suggests, not at the beginning of the beginning, but early enough that the next several years can still create very asymmetric outcomes. That is enough for me. I do not need the first 10% of a move. I do not need the perfect bottom. I need enough of the compounding middle. That is where large wealth is usually built anyway. The people who get paralyzed by not owning from the exact beginning often miss the whole body of the opportunity. That is foolish. A great deal of money can still be made after the first visible move, provided the underlying transition is much larger than the price action already implies. I believe that may be true here. And later, once the infrastructure is obvious, once the productivity gains are everywhere, once the institutions are fully loaded, once demographics and slower broad growth begin making later years more compressed, people will talk about this period with the wrong tone. They will describe it as though it had always been obvious. It will not have been obvious. It will only look obvious in hindsight because the winners will already be visible. That is how history always flatters the past. It removes the uncertainty people actually had to act through. I am not interested in flattering the past. I am interested in acting intelligently in the present. So here is how I would leave it. I would not call this a guaranteed era. I would not call it easy money. I would not call it risk-free. But I would call it one of the rarer periods when several great forces appear to be moving from experiment to economics, when capital is beginning to cluster around a narrower set of winners, when later macro conditions may become less generous, and when the crowd still has enough doubt left in it that the full re-rating may not yet be complete. That combination deserves respect, perhaps great respect, and if I wanted to make a major long-term mistake right now, I would do what the public always does in these moments. I would wait for everyone else to confirm what the next decade has already started saying quietly. I would wait until the market felt polite. I would wait until the headlines were easier. I would wait until the gains were already easier to explain. I would wait until the institutions had squeezed the asymmetry down to something ordinary. In other words, I would wait until the opportunity had become socially comfortable and economically inferior. That is not what I prefer. I prefer discomfort with good odds to comfort with poor ones. That is one of the oldest truths in investing, and it may be one of the most important truths of this entire period. A decade from now, some people will be meaningfully richer not because they guessed every macro variable correctly, but because they recognized that the conditions for unusual wealth formation had appeared while the crowd was still debating whether to believe them. I think that may be what is in front of us now. Not certainty, not fantasy, a rare window. And windows, once they are closed, usually do not reopen on your preferred schedule.